little bit about
the
differentiation between what Fed funds futures are saying and what traders are actually believing in terms of what the Fed will do.
Well, the markets usually have it right. Now, the Fed funds are a reflection of what the traders are doing with their buying and selling. So there's a 20% chance there'll be a hike in March. There's a 50% chance it'll happen by May, and 75% that it's done by June. So there's going to be a rate hike. It's just a matter of it's immediate or not. And the markets, like I said, usually get this right when it comes to interest rates. I will say the Fed's done a fantastic job over the last years with their policy here to get the markets and assets reflated.
So the CME tool actually says 20% chance in March. Warp here on the Bloomberg says 38%. So there's a bit of a difference there. Is there any way to take advantage of that?
No, I don't think so. Looking at the Fed funds rate, what you do is it prices at a discount from 100. So that reflects what they think the interest rate is going to be at that particular time. So I don't know if there's an arbitrage there. I think a lot of this discussion about rates is more symbolic than anything else. The market is fully aware that rates are going to go up. We saw the CPI jump 0.6%. So we're starting to get the inflation that we're looking for. But like I said, we've seen a significant rally and a complete comeback in the stock market. And we're also seeing that happen in other asset classes as well. You're seeing gold, you're seeing oil, you're seeing commodities that have been beaten and battered bounce back just a bit.
So where is the trade then? Because if we know, by May, there's a 75% chance that the Fed will go, what is an attractive futures position to have right now?
Well, what's interesting is we're seeing the Treasury bonds, which are determined by supply and demand, not what the Fed does. Treasury bonds have been trading in a wide range between 147 and 153, so the yield there is about 3%. We haven't seen any flight to quality, even with some uncertain action by the new administration. So the opinion is, if you think rates are going to go higher in the long term, I would be looking at the long-term bonds because we've relaxed a bit after that real big rally that we've seen recently. We've seen a little bit of a relaxation in that Treasury. So I think that is a better trading vehicle than anything else. But I think we're still on the path to prosperity. And this is a good sign when we raise rates. That means that the economy can handle it. And the stock market is continuing to move higher and higher.
So, Alan, what are you predicting will be the impact when we do finally get another rate increase? Roberta Perley of Cornerstone saying that it's going to be maybe a 2 basis point move if the Fed raises in March, for example, instead of May, and a 3 basis point move if it's March instead of June. That doesn't seem like very much.
Right. I hate to disappoint, but I don't see any impact. We've been talking about, rate hikes for years now, and it's had very minimal impact. Until the choice between treasuries and stocks is more in balance, the yield on the S&P right now, the dividend yield is 3%. That's not counting any appreciation and possibly the market moving higher. Compare that to the interest rates, which are, at 1%. There's still no choice right now. It's going to take years and years for the rates to get more normalized so people can choose if they would rather be in the safety of treasuries or in the stock market. Right now, the stock market is the only choice.